This is Richard Peers from Finextra TV, and we're here today at Sustainable Finance.Live, which is being run by Finextra and Responsible Risk. And I'm here with Nick Wise from OceanMind.
Hi, Richard.
Good to see you today.
Thank you very much for inviting
me.
So
we're here with a new format where we're trying to get people engaged in sustainable finance to come up with solutions. And we're targeting it obviously at commercial banking, but we've invited you here with your role in the world of fisheries. Tell us what you do, and we'll try and understand why that matters to commercial banks in a minute.
So I think the key thing that's relevant is, as an organisation, we gather data from a wide variety of sources, including satellites and public data sources, but also private regulatory data sources. And we analyse that and then provide insights to organisations like supply chains, retail organisations and processors as to the risks posed by fishing vessels for particular catches that they've purchased. So they can understand whether those catches were caught in compliance with the relevant regulations, and increasingly other risks as well, such as the risks of forced labour and other crimes associated with fisheries.
So when people talk about ESG, environmental, social and governance, and it kind of sounds really abstract, you're right at the edge of looking at what's going on out in the world's oceans to see whether indeed those principles are being adhered to, and you do that using this sort of satellite data, etc. What are the things that you've learned on this journey, both from the sort of policy and governance as well as the technical execution, that you think will enlighten people really about what the potential is these days to trace these things?
I think that the main thing is it's surprising even to me how much you can actually come to know about a supply chain by observing it from the outside. So using things like satellites and tracking data from vessels, fishing vessels and other types of vessel movements, you can start to understand behaviours and from that make decisions about the kinds of risks that you're faced with. So for example, if you can see that a fishing vessel is out at sea and you can see that they're operating their nets 24 hours around the clock, but they don't have sufficient crew on board to run shifts, then you can start to think, well, how are they doing that without overworking the crew? It can lead you to ask further questions, to understand the risks that you are of the catch that you're buying. Similarly, you can see that vessels are out at sea for extended periods of time, or they're operating in locations where fishing is restricted. You can understand that the compliance risks that are there need some form of mitigation. You need to be asking further questions before you take that product into the chain.
So for the first time, you've then got this ability to literally be the sort of eye in the sky, looking into a place where previously you couldn't tell. People might have been swapping their tracking devices around, they may have been swapping catches out in the middle of the ocean, etc. You can really start to get an idea of the hotspots of risk and then target against that. So what does that mean then? When you start to bring that data back and then you supply that to a wholesaler who's taking the catch on through the supply chain, what does that mean to them, and how are you seeing that affect the wholesale and retail chains?
So the outcome really of the information is one of three things. Either we've looked at all of the information that's available and there's enough of it there and we've cross-referenced it and we can say there's sufficient data to say that was all good in compliance with the regulations. So in that case, it's straightforward. You've low risk and you should move forwards. The next case is that there are holes in the understanding. You haven't got sufficient information to make a judgment. And in that case, the correct course of action is to ask for more information, because the supply chain usually has the information, it's just not made it available. And that's usually the default state when you start. And so over time, you increase the quality of data in the supply chain to allow you to make these more informed decisions. You become either more into the green camp or the final category, the red camp, where you've got all of the information and you can see there's definitely something wrong here. And in that case, you have two potential outcomes again. You can either choose not to buy, and so you're using your economic power to change behaviour in that sense by saying, no, I will only buy from people demonstrating good. Or you can educate and you can talk to your supplier and say, this is what we've observed and this is not acceptable, and so you need to change your behaviour in order to be able to supply to us. And that is a powerful mechanism.
Fantastic. And so as you get through that understanding of your own supply chain as a wholesaler and a retailer, then let's say you're all on the good side of business, you're able to go to your people that are financing you, and you're able to supply them with information that they need to make a risk-based decision. So again, ESG, environmental, social and governance, that data's been hard to come by. What you're saying is your supply chain has really found that and locked and loaded that from a very high quality set of signals. Does that then, do you think, allow financial services industries to start to do a value exchange where maybe they can provide better rates or loans or whatever it may be to that kind of well-managed supply chain?
I think that is the case, yes. So where they now have higher quality information about these things that are going on in their supply chain, they can surface that to the financial institution. And under the expectation that that institution values those things, now the data is there and it's of sufficient quality, it can be used in those risk decisions. But I imagine another situation whereby you have information and it doesn't necessarily show the great things. There are situations, I think, where finance can be used to help you make change in your organisation so that you can show steady increase over time. So having the information, it doesn't mean that you have to have it showing all good before you make a start. Having it in and of itself is a valuable thing.
So if you've got a clear sort of vision that you want to be a sustainable supply chain and you've sort of come clean on that and you're looking for transitionary finance, you've got investors that have got a patient capital sort of mindset, then you, as long as they're seeing the indicators that you're progressing, then you're going to actually be able to transition supply chains that are not great today, is what you're saying.
I think so, and I think being able to monitor that transitionary risk so that you can see, okay, this is the situation today, it's not great, but here is the goal, and as we're moving forwards, you can see the improvements because the data will allow you to see that. I think that is a valuable thing.
So on one level also, you know, the consumer of the fish knows they're getting a more sustainable fish and that's, badged and managed. The bank knows that they're getting a more sustainable, risk profile. But also, I suppose, because these loans get securitized and passed around the financial services industry, end up in people's pensions and so forth, and people are consciously wanting to buy sustainable pensions or ISAs, then we're going to have more confidence that actually that is what we're buying. But it all stems from really this ability to track and trace that we've never had before.
Yes, so it's the fact that there is an independent expert that's looked at the data and said this is horribly complicated, but we've extracted and boiled it down to these important principles that you can see, and here's regulations, and here's how we demonstrate that they are or are not compliant. Getting that information now, I think, allows you to demonstrate that your particular instrument has more value or less value than you might otherwise have had.
Yeah, and I suppose, of course, OceanMind must be, the most wealthy company in the world with all the biggest computers and millions of people to be able to achieve this. Or, what's the reality? Or are you a small organisation, leveraging technology?
It is indeed that. So we're only 18 people. But we're monitoring locations in 20 countries around the world, and we're using the satellite data and artificial intelligence to really power up our capability. So without that data gathering capability, remote sensing, and then the ability for the computer to classify and understand the behaviours that arise from it, the team wouldn't be able to do the work that they do. But because we have that, we only need a small team of experts who can really then help interpret the data into a form that the people who need to consume it can understand it.
So if only 18 people can do this, there's no excuse for the biggest banks in the world not to be delivering for us. We'll end with that challenge. Nick, thank you so much and appreciate you being with us today.
Thank you, Richard.